It's Friday. It's Forex Friday. Hi guys, welcome back to my kitchen and welcome back to another video. On these Forex Fridays, we go over the trades that I took this week, what I learned, maybe a thing or two to look out for next week. But this week is a special Forex Friday because we had a major news event on Wednesday, which was FOMC. For those that are new to trading, that stands for Federal Open Market Committee? I don't even know. Doesn't really matter. But it's a super important news event and it's something that the market was looking out for and anticipating for the last 2 weeks. How do I know this? Because the market was dead right before and right after things started to move. So this week I want to focus specifically on FOMC, how I traded it, what I looked for, how I traded it, how I positioned myself before the event, and what I looked for after. So this is the video that I wish I had seen when I first started trading, and I'm gonna make it. We're making it right now. So with all of that being said, let's get right into it. So before we jump into the charts, I just want to go over some of my thinking behind this event. So it might get a little bit confusing or complicated if you are really new to trading. So just grab a cup of tea, a little notepad, and take some notes. We'll do it together. So the reason the market wasn't moving before FOMC, so especially last week, there were very minor moves, and Monday and Tuesday of this week were also very quiet, is because the market needed to know if the Federal Reserve, the central bank in the United States, was going to change their stance on inflation and how they plan on tackling inflation. So for the average Joe like you and I, we know that prices have been rising, but the Federal Reserve likes using the CPI figure, which is a basket of goods, to track either the rising or falling of prices. It's kind of legit, it's kind of not legit. Everybody knows prices are rising a lot faster than what the CPI figure is saying, but nonetheless, the CPI figures have been increasing over time. Now, the Federal Reserve, their target is always 2%. That's what they want. That's what they've been saying they want for a long time. Hold that thought. Okay, so it looks like finally, since COVID and all of the stimulus that has come with COVID, that inflation is actually going to start being a real thing. Now, you would think this is good since it's the Fed's target of reaching 2%. But the problem is that you don't want inflation to run too hot. You don't want to get too far above that 2% level or people start getting really cranky. You've heard the stories of places like Zimbabwe where they've got like $1 trillion bill. You don't want that. So stick with me. This all connects very, very closely to interest rates. Get in your head. Interest rates are key. And the stock market has gotten very used and very accustomed and has really enjoyed low interest rates. So the problem with inflation starting to rise is that the main way that the Federal Reserve starts to fight back and tries to lower inflation is by increasing interest rates. Companies can no longer borrow at the same cheap rate that they've been able to borrow at since like 2008, 2009. And so stepping back a little bit, that drastically changes, interest rates drastically changes how hedge funds and investors and people, even like you and I, will organize their investing and their trading. The Federal Reserve has made it very clear that they don't plan on increasing interest rates anytime soon. But there have been signs of inflation starting to rise faster than expected. And certain countries have been changing their rhetoric ever so slightly, such as the Bank of Canada, the BOC, and even the Bank of England started to somewhat tweak their tone a little bit as to when these rate hikes are going to be coming. So that brings us to Wednesday, when the Federal Reserve spoke about whether or not they were planning on increasing interest rates sooner than expected. What happened? Good question. I'm glad you asked. Cheers. What happened What happened was that there was an indication that some of the members of the Federal Reserve are looking at increasing rates slightly sooner than expected. How did the market react to this? Well, Mr. US dollar really liked this news, which was very bad for the bulls of gold, for people that wanted gold to rise. So specifically for this event, I was looking at gold. I was looking at gold and how to trade it. So my theory before the event was that people were long the US dollar. You can see it in the charts that the DXY started to increase, and then there was a stall in price as the market waited for the news event to come out. In terms of a trade to take, I was watching specifically gold. And so during this sort of limbo period when the DXY, the US dollar, was increasing, we saw a slight drop in gold over the past couple of weeks. Gold really hasn't moved that much other than a slight decline. So this is how institutions were positioning themselves. They had a hedge on the US dollar in case of a more hawkish Federal Reserve. This allowed them to hold US dollars and to profit off of any potential hawkishness that comes out from the Federal Reserve. And that is exactly what happened. So institutions were able to add to their positions and were able to profit tremendously off of the moves that we saw. So that would be profits off of being long US dollar and short gold, since they are inversely correlated. So I hope that makes sense, but I think that's the gist of it. When it comes to FOMC, you want to see how the market is positioning themselves, what's the worst case scenario, what's the best case scenario. But really all it comes down to is tracking the market expectations for rate hikes, because the higher the interest rate, the stronger the currency is going to be. The higher the CPI, it weakens a currency because the purchasing power drops. So that's a negative for a currency, but it could lead to a tightening of monetary policy, which will actually strengthen that currency. So it's really all about interest rates and how the central banks are reacting to inflation. That's been the theme for the last few months and is going to continue to be the theme in the next few months. So with all that being said, I hope that made sense. So now we're gonna hop into the charts, and I want to go over gold specifically for what I looked at, why I did not take the 1820, 1825-ish buy area that a lot of traders I saw online did take, and it got nasty very fast, and all of those good things. On top of FOMC, I also took other trades this week that I posted on my Twitter account. So if you aren't following me on Twitter, the link is in the bio, and let's get into the charts. Okay, so this is the gold chart that I had for this week. So we're gonna start off at what happened at the beginning of the week. And the first trade that I took was at this green box right here, 1845 and 1840. Price didn't actually hit 1840, it only hit 1845. So I only managed to get in half of a position, but that still worked out just fine. But if we go back to last week, what I mentioned in last week's video was that big moves were coming up because of FOMC, and so the price action in gold was very interesting. You could see here at the 1900 level, you could see that institutions were starting to build up a sell orders. We can see that from the wicks and the constant rejection of this level. So it started off as a support level here, and then once we broke it, we retested it multiple times, one here, and then more here. And this also acted in line with the US dollar, the DXY increasing. So we could see that the hedge was being built up and that pre-FOMC people were long US dollar. So this really unwound come Wednesday when FOMC did happen. So here, this little box here, I had a sell, which is at the 1880 area. The reason for that sell, which didn't get triggered, was that it was a 61 fib with, at the time, these moving averages, and it was also somewhat of a key level with support turn resistance just slightly higher. So that would have been a good sell, but it didn't hit. So the 1845, I closed most of it at 1855, so that was 100 pips depending on how you calculate it, so that was fine. And then we got the massive sell-off, and 2 days later, even with it being Friday, we haven't had much of a bounce. So this green box here was the area that everybody was looking at. I myself was even looking at it. I had the box drawn for a potential buy, but I didn't take it. and a lot of traders did take it, and it was nasty. I saw some screenshots online. It was nasty what happened to a lot of traders. So I want to talk about quickly why I didn't take it. So the reason for having it was it's a very large 38 fib drawn from this bottom here. So it was a 38 fib. It was at 1820, so it's somewhat of a round number. And then we also had the 100 moving average here on the daily chart, and it was a key level as well. So there's quite a few confluences for 1820, 1825, but the reason I didn't take it was twofold. For starters, clearly the momentum on gold was bearish and continues to be bearish, and it was equivalent to catching a falling knife. It was just too risky. So for that reason, I didn't take it. But secondly, and this is something that I didn't come up with, it's actually Seb from FX Cartel that's been talking about this a lot, and that is looking at silver to align with gold. I haven't actually been trading silver. It's something that I'd like to get into eventually, but Seb has been trading silver quite a bit, and he looks for both of the commodities to line up as an added confluence. And in this case, silver did not line up. So I don't want to make this video longer than it already is. So I'm not going to show you the chart, but I encourage you to go and look at silver and see the tech levels that were lining up at the same time that gold was hitting 1820, 1825. And you could see that it was in kind of no man's land. It wasn't at a support. It wasn't lining up for a buy. So that was a second reason for not taking it. Now, everybody uses fundamentals a little bit differently in terms of trading, but I think one of the best ways to use fundamentals is to implement them to stop you from getting into certain trades. You don't need to necessarily always have a fundamental reason for taking a trade. However, having a fundamental reason to not get into a trade, to avoid certain trades, can really increase your win rate and stop you from taking unnecessary losses. And I think this was a really great example of that. So on my Twitter account this week, I posted a bunch of the setups that I took, and it was a good week for me. So I didn't want to risk getting into a sell that I didn't have to, but there was definitely an opportunity or two to hop in on this trade. I think it's reasonable that most people, including myself, were expecting a bounce, a pullback at some point that we just haven't gotten. This is a really large move. We're at 1775, and it was at basically 1870. So this is about $100 drop, which is very significant without much of a pullback. So I think next week we'll be looking for that pullback. But if you drop down onto a lower time frame, and again, I don't want to take credit for this. This is something that Seb is pretty well known for, and that is hopping in on the 38 fib on the 15-minute chart. And so we could take this high to this low, and you could see we came right to the 38 fib. You could have taken your sell position there if you had missed the initial drop. And as you can see, that would have worked out quite nicely. So I didn't take that, but that's something that you could have done if you didn't get in on the initial drop. So I hope that that helped you guys out a bit. I really think that this week and this FOMC was really interesting, and there was a lot to learn. I know myself, I learned a lot. Again, I'm no expert. I still have a lot to learn, but I definitely learned a lot this week, and I'll be keeping this FOMC in mind for the future ones. And I think overall, in terms of trading news, this was a good learning opportunity. So let me know in the comment section down below how you guys did this week, what you think of gold's reaction, and if you learned anything this week. I always really enjoy hearing from you guys. If you made it this far, you have my gratitude. And until next time, I will see you in the next video. Peace.